Lead alert, lead alert. Most agents are out here begging for business. We're just trying to keep up with the volume. Pass the exam. Join the rotation tomorrow.
All right, let's talk about something that sounds kind of sleepy, but is actually packed with potential: your life insurance dividend. Most people just see it as a nice little check from their insurance company, a refund, but what if it's more than that? What if it's the key to actually supercharging your policy? So, are we going to look at this as a simple refund, or are we going to treat it like rocket fuel for your financial future? Let's dive in. So let's start with this question right here, because honestly, changing how you think about this, from seeing it as just a refund to seeing it as investment capital, that is the whole game. This isn't just about getting a little bit of your money back. Nope. It's about putting that money to work for you. Okay, so to really get a handle on our options, we have to be super clear on what a dividend from a participating whole life policy actually is. And spoiler alert, it is not like a stock dividend. Not at all. It's something much, much more fundamental to how the policy works. At its heart, a dividend is really just a return of your premium. See, the insurance company makes a bunch of predictions: how many claims they'll have, how their investments will do, and they charge you a premium based on that. But when things go better than they planned, maybe fewer people passed away or their investments did really well, they end up with extra cash. And since you're with a mutual company, you're a part owner, so they give a piece of that extra right back to you. And this leads us to an absolutely crucial point. You've got to get this. Because it's a return of your own money, they basically overcharged you, right? The IRS doesn't see it as income or a gain. It is tax-free. And that is a massive, massive advantage that you need to keep in your back pocket as we go through all your choices. So now for the cool part. You're actually in the driver's seat here. You get to call the shots on what happens next. The insurance company gives you 5 different options. And to make it easy to remember, we've got this handy little acronym, CRAPO. Yep, that's CRAPO. It stands for cash, reduction of premium, accumulation at interest, paid-up additions, and 1-year term. Now, each of these is a different strategic move. Understanding what they do is the key to getting the most out of your policy. So let's break them down one by one. First up, the easiest one, cash. It's exactly what it sounds like. The insurance company just mails you a check for the dividend amount. It's simple, it's direct, and hey, who doesn't like getting a check in the mail? But while it's tempting, you have to remember, taking the cash means that money is no longer working for you inside the policy. Okay, next is reduction of premium. This is a really practical option if you're looking to lower your out-of-pocket costs. The company just takes your dividend and applies it right to your next bill. So the amount you have to pay goes down. It's a pretty smart way to manage your cash flow for sure. Option 3 is where it starts to get a little more strategic. It's called accumulation at interest. With this, you just tell the insurer to hang on to your dividend, and they stick it in what's basically a savings account that earns interest. Now that sounds great, right? Your money is growing. But there's a catch. Okay, lean in for a second, because this is really important. If there's one thing that people consistently miss, it's this. That accumulation option, as good as it sounds, comes with a hidden tax trap that you absolutely need to know about. So, here's the deal. Remember how the dividend itself is just a tax-free return of your premium? Well, that part's still true, but any interest that it earns, that's new growth. That's a gain. And you better believe that interest is considered taxable income for the year. It's a small difference, but it's a vital one. All right, let's talk about actually building some serious wealth. We're moving on to the options that can truly turn your dividend from just a simple refund into that rocket fuel we were talking about. And this next one, it's often the default choice if you don't pick anything, and for a very, very good reason. We are talking about paid-up additions, or what we call PUAs. When you pick this, your dividend is used to buy a tiny, fully paid-up sliver of whole life insurance. Think of it like a mini policy that gets stapled onto your main one. And here's where the magic happens. It instantly increases your total death benefit, and more importantly, it increases your total cash value. The best way to think about this is like you're adding a supercharger to your policy's engine every single year. These little additions don't just grow your policy's value on their own, but they can actually earn their own dividends down the road. That creates this incredible compounding effect over time. This is how you build a real financial asset, not just own an insurance policy. And finally, we have the 1-year term option. You'll sometimes hear this called the 5th dividend option. In this case, your dividend buys a term insurance policy that lasts for 1 year.
It's a very specific, strategic choice if you want to maximize your death benefit for a short time, maybe while you have a loan out against your policy's cash value. So when you look at all 5 of these, the decision really boils down to this, doesn't it? Do you want to use that dividend for a short-term win, like some cash in your pocket or a lower bill? Or do you want to reinvest it and build a bigger, stronger, more valuable financial asset for your future? And that's why the core message here, the one thing I want you to walk away with, is this. When it comes to that life insurance dividend, don't just take the cash. Use it to build the engine. Trust me, your future self is going to thank you for it. Thanks for tuning in.